Hello everyone, my name is Alozie Favor and welcome to another segment on Excel. In today's lesson, we'll be looking at capital budgeting techniques. Now, it will interest you to know that most managers around the world are faced with making big decisions that has to do with big projects because of the growth of their firms, its profitability, and the risk therein. Now, every company needs to decide on how they'll spend their money on major projects that will affect their company's financial results. And this is where capital budgeting techniques come in. This technique is what helps these firms to analyze and spend their fund wisely. This technique also helps firms to plan and control projects that will affect more than 1 year financial results of their companies. Now, in today's lesson, we'll be looking at two essential modern capital budgeting techniques, which are the net present value and the internal rate of return. Nevertheless, you can still make use of other capital budgeting techniques like the profitability index, the net, the payback period, and others. But in this lesson, we'll be looking at this important two, the net present value and the internal rate of return. Now, without wasting much of our time, let's get right into it. Now, we have a question before us. This question goes thus: Super F Computer Hub is planning to invest in a project with an initial cost of investment which amounts to 800,000 and a discount rate of 12%. Below are the estimated cash flow. So, Super F Computer Hub estimates that in the first year of investing $800,000 in this project, they will be making a return of $300,000, and in the second year $400,000, in the third year $600,000, in the fourth year $500,000, and in the fifth year $200,000. Now, we've been asked to find the net present value, and then we are going to advise this management on whether they should invest this huge amount of $800,000 in their said project. Now, having known what the questioner asked us to do, let's go into the solution. How do we solve this interesting question? That's great. Now we have our question here. Here's the solution. So, I know these are just numbers. So I'm going to put in a tab for us to know what these numbers are very quickly. Great. So in here I'll just write in and then I'll have great. Now here we are. So this project is going to last for a period of 5 years, and we have our estimated cash inflow this manner. So you can see from the first year to the fifth year we have our cash inflow. Now this is the $800,000 invested, which is our cash outlay, sometimes called cost of investment. And then we have a rate. You see, this amount of 800,000 naira was gotten at a rate of 12%. So we have our rate of 12%. Now when you calculate that 12%, it gives us 0.12. Now let's calculate. So first of all, to know the net present value, we have to find the present value of this amount which we want to invest in, and it's just simple. So we just come to our formula bar, bring in our equal to sign, Here we are. And then type in the net present value. Bring in our NPV function. When that comes up, you click on that. And then what goes next is the rate. As you can see here in the formula bar is the rate. So our rate is on cell address C39. You can see that very well. Our rate is on cell address C39. So we'll click on that. And then what comes next is the value. Now this value are simply our cash inflow, the amount we are going to be getting as this investment goes on. So we'll have our cash inflow coming from cell address C41 down to cell address C45. And so I'll click on that cell address and then I'll hold and drag this till the last cash inflow. And then when I'm done, I'll click on my tab. And you can see from this calculation we have a present value of $1,445,047. Sorry. And having known this, the next thing we'll be calculating is the net present value. Now we've gotten the total present value, which is the net present value, the total present value of this calculation. All we have to do to know if this project is viable or not is to subtract this amount from our cash outlay. We simply subtract this amount from our cash outlay of 800,000. Now this is just simply Excel basics. You bring in your equal to sign. Then what you do next is to type in the cell address of our cash outlay, which is 800,000. Which is on cell address C40. And then what goes next is your minus sign. Minus the next cell address of our present value, which is on cell address D45. Click on that. And then when you're done, you hit on your tab key. And then we can see that our net present value is an amount of $645,047. And just to make that clear, good. Now this is what we have. So the question also tells us that based on this amount we have gotten, we should advise the management if this is valuable. So I'll leave this part to you. Let me know if it's valuable after watching this video. But then I would love to say this video will not be complete if I do not give you the answer. So I'll just say, based on this calculation we've done, what do you think? Is this business viable or is it not viable? Is it good to invest in or is it not good to invest in? Let me know in the comment box and we'll kick off from there. So if you have any question also, not about the answer, just any question different from the answer I've asked for, yeah, just chat me up on WhatsApp and I'll get back to you. Once again, my name is Alex Jefebo. I hope this video is very comprehensive for you to understand. And on the second capital budgeting technique, we'll look at that and see what we can do on the other video, which is the internal rate of return. For now, let's dwell on the net present value. Ensure you know how to calculate this and let me know if you think the business is viable or not. Just let me know. I'll leave you with this now for now. I'll see you in the next video.